The markets are flirting with record highs after a debt deal in Greece was finally reached on Friday. But will those levels hold this week, especially given Federal Reserve Chair Janet Yellen's testimony on Tuesday in front of the Senate Banking Committee? Let's bring in Steve Freedman, Senior Investment Strategist at UBS, with us now from New York. And Steve, stocks reached record highs on Friday with the S&P 500 over 2,100, and many analysts had their year-end targets at 2,200. So it got pretty close there. Will these levels hold, or is this just a sign of more volatility to come?
Well, I think just stocks reaching all-time highs is not in and of itself very relevant information. I mean, ultimately, the market tends to go up over time, so you're going to reach new highs regularly. I think what matters here is where valuations are and what the earnings dynamics is likely to be. We think valuations are slightly above long-term averages, but nothing that would be worrisome really in terms of the big picture. And more importantly, we do think that earnings are going to continue growing. We think that earnings growth in the high single-digit rate is quite likely this year, and that should give you more or less the pace of price gains over a full year.
All right, now we also have Fed Chair Janet Yellen's testimony tomorrow on Capitol Hill. How closely should investors be watching this?
I think they will be watching to the extent that since the minutes from the last FOMC meeting, we did get that strong labor market report, and it would be interesting to see if she acknowledges that and if there's a little bit of a change in tone. I think usually these are pretty broad messages. They're really directed at Congress more than to the markets, and therefore I wouldn't expect this to be a very relevant market moving event overall.
So no clues on a possible rate hike?
She's not going to go ahead and announce any change in language. I think that would be the next thing that the market would be looking at, and I think that's really something we'll see rather in March to see if this patience expression gets removed. I wouldn't expect that to be something that comes out this week out of the congressional testimony.
All right, and we'll be watching that. And let's also talk about sectors that you like and dislike. What are you telling clients right now?
So overall, within U.S. equities and in line with our constructive view on the market, we are advocating for pro-cyclical sectors. And specifically the ones that we like currently are technology, consumer discretionary, as well as industrials. Tech and consumer discretionary are the two favorite sectors. We think technology, there are just some pretty strong growth drivers. Part of these are structural growth drivers at a price which is relatively attractive. And for the consumer discretionary sector, here it's really a matter of having relatively solid fundamentals for the consumer, such as a solid labor market, but also this boost from lower energy costs, which we think at this point hasn't fully been reflected in consumer behavior, and we expect that to happen over the coming quarters.
And any sectors that you're trying to stay away from?
And generally speaking, we think that you want to stay away from rate-sensitive sectors, so all the bond proxies. We do expect bonds to rise over the course of the year, and we think that those sectors are likely to be more exposed.
All right, Steve, we'll leave it there. Steve Freedman, Senior Investment Strategist at UBS. Thanks for joining us.
Thank you.
I'm Scott Gamm, and you're watching The Street.